Hello, folks. Today, 30th January 2026, the global financial markets reacted to a series of important economic releases from North America and Europe, offering fresh insight into trade dynamics, labor market strength, inflation trends, and overall economic momentum. Canada, trade deficit widens. CAD faces mild pressure. Canada released its latest trade data for November, showing a widening trade deficit that exceeded market expectations. Exports declined to 63.94 billion Canadian dollars, while imports rose to 66.14 billion, resulting in a merchandise trade deficit of 2.2 billion Canadian dollars. The figures suggest that while domestic demand in Canada remains relatively resilient, external demand has softened. This imbalance places moderate pressure on the Canadian dollar, although its overall direction remains closely tied to energy prices. As long as oil markets remain supported, downside risks for the Canadian dollar may stay limited, though upside momentum appears capped in the near term. Starting in Asia, attention is firmly on Japan, where Tokyo inflation indicators for January serve as an early signal for nationwide price trends. Tokyo's Consumer Price Index, along with the CPI excluding fresh food and energy, is closely monitored by global markets as a leading indicator for the Bank of Japan's policy stance. The core measure previously stood at 2.3% year-on-year, with the latest consensus slightly lower at 2.2%. Any confirmation of easing inflation pressures would reinforce expectations that Japan's price growth is gradually moderating, even as it remains above the central bank's long-standing target. For currency markets, softer Tokyo inflation would typically limit upward pressure on the Japanese yen, particularly in an environment where global yields remain elevated. Conversely, a renewed upside surprise would strengthen the case for policy normalization later this year, potentially lending support to the yen and influencing broader Asian FX sentiment. For global risk assets, Japan's inflation path matters as it feeds into expectations around liquidity conditions and cross-border capital flows. Turning to Europe, the focus shifts to growth data, with preliminary fourth-quarter GDP figures from Germany and the broader euro area taking center stage. Germany's quarterly growth was expected at a modest 0.2% after a flat reading previously, while annual growth remains subdued near 3%. These figures highlight the fragile state of Europe's largest economy, which continues to struggle with weak industrial output, soft external demand, and lingering effects from tighter financial conditions. At the Eurozone level, seasonally adjusted GDP growth was expected to slow slightly on both a quarterly and annual basis, underscoring concerns that the region is flirting with stagnation rather than recovery. Markets interpret these data as reinforcing the narrative that economic momentum in Europe remains weak, even as inflation pressures gradually ease. For the euro, subdued growth data tends to cap upside potential, particularly against currencies backed by stronger economic performance. If GDP figures meet or undershoot expectations, it strengthens the argument that the European Central Bank may need to adopt a more accommodative stance later in the year, especially if disinflation continues. Bond markets typically respond by pushing yields lower, reflecting reduced growth and policy tightening expectations, while equities may find limited support from the prospect of easier monetary conditions. Later in the European session, inflation returns to the spotlight with preliminary consumer price data for January. Headline CPI year-on-year was expected to rise to around 2.2% from 1.8% previously, while the harmonized index of consumer prices was seen holding near 2%. On a monthly basis, inflation was forecast to remain flat. These figures are critical for shaping expectations around the ECB's next steps. A rebound in headline inflation, even if driven by base effects or energy components, may complicate the disinflation narrative and encourage policymakers to proceed cautiously on rate cuts. Markets will closely assess whether price pressures are stabilizing near target or showing signs of renewed persistence. For the euro, firmer than expected inflation could provide near-term support, while softer readings would likely reinforce expectations of earlier policy easing. In commodities, European inflation data matters particularly for gold, which is sensitive to real interest rate expectations. Lower inflation and softer growth generally support gold prices by reinforcing the case for looser monetary policy and lower real yields, while firmer inflation can weigh on bullion if it delays rate cuts. Shifting to the United States, attention centers on producer-side inflation, with the Producer Price Index excluding food and energy for December expected at 2.9% year-on-year, slightly below the previous 3% reading. This measure is closely watched as a leading indicator for consumer inflation trends and corporate cost pressures. A continued moderation in core producer prices would support the view that inflationary pressures are easing along the supply chain, strengthening confidence that the Federal Reserve's restrictive policy stance is having the intended effect. For the U.S. dollar, softer PPI data typically reduces support, particularly if it reinforces expectations for rate cuts later in the year. Treasury yields may drift lower in response, while equities often benefit from the prospect of easing financial conditions. From a broader risk perspective, the combination of slowing inflation and mixed growth signals keeps markets in a cautious but constructive mood. Equities remain sensitive to the balance between disinflation and economic resilience, while safe haven assets such as gold and high-quality bonds continue to attract interest during periods of macro uncertainty. Across currency markets, the U.S. dollar remains influenced by relative growth and policy expectations. Compared with the euro, where growth remains fragile, and the yen, where policy normalization remains tentative, the dollar's direction is increasingly data-dependent. Any confirmation that U.S. inflation is cooling without a sharp slowdown in activity would support risk-on sentiment while limiting extreme moves in foreign exchange. Overall, today's economic calendar reinforces a familiar theme for global markets. Inflation is easing, but unevenly. Growth is slowing, but not collapsing. And central banks remain cautious as they balance the risks of acting too early against the costs of staying restrictive for too long. Market participants continue to adjust expectations incrementally, with each data point adding nuance rather than clarity. As investors look ahead, attention remains firmly on whether upcoming inflation data confirms a sustainable return toward central bank targets, and whether growth indicators stabilize enough to avoid a sharper downturn. Until then, markets are likely to remain sensitive to macro surprises, with volatility driven more by expectations than by definitive shifts in policy direction. Global financial markets reacted to a series of important economic releases from North America and Europe, offering fresh insight into trade dynamics, labor market strength, inflation trends, and overall economic momentum. Canada. Trade deficit widens. CAD faces. Mild Pressure Canada released its latest trade data for November, showing a widening trade deficit that exceeded market expectations. Exports declined to 63.94 billion Canadian dollars, while imports rose to 66.14 billion, resulting in a merchandise trade deficit of 2.2 billion Canadian dollars. The figures suggest that while domestic demand in Canada remains relatively resilient, external demand has softened. This imbalance places moderate pressure on the Canadian dollar, although its overall direction remains closely tied to energy prices. As long as oil markets remain supported, downside risks for the Canadian dollar may stay limited, though upside momentum appears capped in the near term. United States labor market remains resilient. In the United States, labor market data continued to confirm economic resilience. Initial jobless claims rose slightly to 209,000, but remained near historically low levels. Continuing claims declined modestly, reinforcing the view that layoffs remain contained and hiring conditions stable. This data supports the Federal Reserve's cautious policy stance. indicating that there is no immediate need for aggressive interest rate cuts. As a result, the U.S. dollar remained well supported, particularly against lower-yielding currencies. U.S. trade balance. Structural deficit persists. The U.S. trade balance for November showed a larger-than-expected deficit. The goods and services trade deficit widened to $56.8 billion, while the goods trade deficit expanded to $86.9 billion. While trade deficits are generally negative for a currency over the long term, the market reaction remained muted. Strong domestic demand continues to drive imports higher, offsetting concerns in the short term and keeping the dollar relatively stable. Productivity and labor costs send positive inflation signal. One of the most market-relevant releases came from U.S. productivity data. Non-farm productivity rose by 4.9%, while unit labor costs declined by 1.9%. This combination is viewed as highly favorable for the inflation outlook. Rising productivity alongside falling labor costs reduces inflationary pressure without damaging growth, supporting the Federal Reserve's soft landing narrative. These figures reinforce expectations that interest rates may remain elevated for longer, but without the need for further tightening. Eurozone. ECB maintains data-dependent stance. In Europe, comments from European Central Bank officials reinforced a cautious and data-driven approach to monetary policy. While inflation has shown signs of easing, policymakers emphasized that risks remain and that any future rate decisions will depend on incoming economic data. The euro remained range-bound, with price action driven largely by movements in the U.S. dollar rather than euro-specific strength. U.S. growth indicators show stabilization. Additional U.S. data provided encouraging signs for economic activity. Factory orders rose by 2.7%, indicating a rebound in manufacturing demand. Wholesale inventories increased by 0.2%, suggesting confidence among businesses in future consumption trends. These indicators supported U.S. equity markets and reinforced broader optimism that economic growth can remain steady without triggering renewed inflation. Energy markets. Natural gas remains volatile. In energy markets, attention remained on U.S. natural gas storage data. Ongoing uncertainty around weather patterns and seasonal demand continues to drive volatility, making natural gas prices particularly sensitive to short-term supply and demand shifts. Market outlook overall. Markets are transitioning from a phase dominated by inflation concerns to one focused on growth sustainability. The U.S. dollar remains supported by strong labor conditions and improving productivity, while the Canadian dollar faces mild pressure from trade data. The euro continues to trade within established ranges, awaiting clearer signals from the ECB. Gold and commodities remain sensitive to movements in U.S. yields and the dollar, while equity markets benefit from signs of economic resilience. Market participants remain cautious but constructive, closely monitoring upcoming data releases for confirmation of current trends. USD, stable to bullish on labor strength and productivity. Gains, CAD. Mildly pressured by trade deficit, oil remains. EUR, range-bound, awaiting clearer ECB direction. Gold, sensitive to yields and USD strength equities, supported by growth data and soft landing optimism. Overall market theme markets are transitioning from inflation fear to growth sustainability. Volatility remains elevated, but risk sentiment is cautiously constructive. Closing, 9:30-10 WEG. That's all for today's market outlook. If you found this breakdown helpful, stay tuned for our next update. Trade safely, manage your risk, and thank you for watching.